Hello and welcome to today's episode of Pivot to Profit, where we are here to help you know your numbers, increase your profit, reduce your taxes, and grow your wealth. I am joined today by our tax expert, Alexis Sidney. What's up, girl?
Hey, what's going on, everyone?
We have an amazing topic today. It is quarterly tax payments, how to avoid the penalties and the stress of it. But listen, before we dive in, if you're a business owner, founder, and you're struggling with understanding where your numbers are, trying to figure out, do I owe, do I not owe? Should I write the check? Should I not write the check? Where am I at? Can I buy this thing? Should I hire this person? We would love to help you at Pivot Business Group. Simply go to pamjordan.com to book a call with our team. We would love to support you. Alexis and her team of tax gurus will get you straight, and our bookkeeping team and CFOs would love to help you. All right, Alexis, this is a fun one. You and I might not agree on all of this, so I'm excited to get into it. Alexis, quarterly tax payments. Give us a brief description of what they are.
Yes, so quarterly tax payments are quarterly payments that business owners that anticipate having a net profit at the end of the year should be making to the IRS. And if your state, if you're required to file state taxes, because as we know, not all states have state taxes, you should be factoring in quarterly estimated tax payments to the state as well. That money just goes into an account and it's held. And when you file your taxes at the end of the year, if you're spot on, then you don't have to pay the IRS or the state. But if you're off, then you have a balance due and there may be a penalty applied to it if you don't pay the right amount. How about that?
Okay, that was very simple. I love it. Now, there's a whole lot more that goes into it. So, what are the dates in which these estimated taxes should be paid?
So typically they're on the quarterly schedule. So I always go with the 15th. That's what's on the IRS site. So definitely April 15th. Then we have, help me out here,
July,
July the 15th. And then there
October,
should be
and January.
October and then January 15th for the following year. So those are the dates where you typically should be making those payments.
Okay. Now, how is your tax professional calculating what your quarterly estimated taxes should be?
Oh,
This
this
is
is so
tricky.
fun. It's fun and tricky. So here is this. Typically, when taxpayers have a liability due, they'll get as a part of their tax return every year these coupon vouchers, and the tax software automatically spits them out as a part of your tax return. With that, I call it the cookie cutter approach because simply what it's doing is just saying, hey, you had this tax liability last year. We're going to base this year. It's going to be the same thing. We're going to take the number divided by four. Here's your coupon. Send us our money every quarter. So that's way one. However, this is where the expertise comes in when you're working with a strategist because let's just say your picture is totally different. Let's say, hey, you had skyrocket sales for quarter one, and it's totally different than last year. And we're basing the tax liability off of what last year was going to be divided by four. You can be in some serious trouble when you go to file your taxes, or not trouble, but just a bad look because you didn't
Surprise.
factor, yeah, that one. You didn't factor in any influxes of revenue or decreases. The same thing is, let's say your business just plunged for whatever reason, sales decreased, you had a loss, but here you are still sending the quarterly estimated payments to the IRS or the state, and you have no tax liability due. You just gave away money that you didn't have to. So,
Right.
this is where strategy comes in, where you're working with a tax strategist and we're looking at what the forecast is for the year as far as your, projected tax liability, adding any tax strategy that we may need to account for and saying, hey, based off of what we forecast and what strategies we're implementing for you, this is your calculated, not your cookie cutter tax liability amount, but this is what we calculated for you. So this is the amount you should send, or you don't have a tax liability. You don't need to send anything for this quarter and look at it every quarter until it's time to file taxes.
I love it. I love it. So I've got some call outs from what you just said. Business owner, your tax professional, the person who keeps you compliant with the IRS, is taking data, putting it into a software, and the software is spitting out vouchers. The software is assuming that last year, if you paid $10,000 in taxes, you're going to have to owe $10,000 in taxes this year. So they divide 10 by 4, and those vouchers say pay the money to the IRS. Period. End of story. That's
Right.
where the line in the sand is. And so, what you need to understand is if you're trucking along exactly like you did last year, stay with your tax professional. Pay those little vouchers. Do exactly what it says, because if 25 is going to be exactly like 24, your vouchers are right. But there is a distinct difference in tax strategy because your tax strategist is going to say, okay, Q1 of this year is significantly better than Q1 of last year. We need to look at what your tax liability is going to be and or implement additional tax strategies so you don't have a big surprise tax bill. Because if 25 kicks 24's tail and you are killing it and you just pay what the cookie cutter voucher says, you're going to have a tax bill unless you're having conversations with a tax strategist to help prepare you for it.
Well said.
This kills me because people so often just pay the vouchers and think everything's going to be fine. And they're like, oh man, I can't believe I owe taxes. Well, just because you paid the cookie cutter amount, that doesn't mean that that was an actual updated view of how your business is doing. Because to your point, Alexis, this year could be better or worse than last year. And you don't want to overpay either. Because if you overpay, how do you get that money back?
Well, you'll get it back once you file your tax return. Hoping you don't owe the IRS any other outstanding tax bills. But if that's not the case, when you go to file your taxes, you'll put it in as a credit and then you'll just get the amount refunded to you. But who wants to lend the IRS money if you don't have to?
Not me. I'll tell you what, I can do a whole lot more with that money than they can. So let's talk about what happens if a business owner does not pay their quarterly estimated tax payments on April, July, October, and January 15th, respectfully.
Yes. So great question. I get this question asked all the time. I have business owners who are frantic, like, oh my God, I'm going to get penalized. So here is this. I have not, in my 24 plus years in the accounting world, I have not seen a business owner get sent a letter from the IRS saying, hey, you didn't pay your quarterly estimated taxes. Here is a penalty. I'm not sure if that's going to change in the future, but I haven't seen it. But nonetheless, what happens is when you go to file your taxes, April 15th, when you do your personal return. If you don't have the quarterly estimated taxes paid, so let's just say you're getting a refund, hey, you're great to go, nothing happens. The only issue is when you have a balance due. Then you'll see estimated tax penalty apply to your return, and the amount is based off of the amount you owe. So there's not a flat fee rate. It just depends. I saw one the other day for $50,000. I was like, whoa. But, it just really depends on the amount due. I do see sometimes that anything under, I believe, $900 or whatnot of a balance due, they give you some grace and they don't penalize you. But anything over that amount, in certain years, I've seen where they do apply a penalty. And then you'll just get penalized and pay the amount, or it's added to your tax bill if you choose not to pay it in full at the time it's due.
So are we talking, obviously that 50,000 was an outlier because they must have had a big tax bill and it must have been,
Huge.
a big number. But say for example, 10, so say a business owner ends up owing $10,000 to the IRS, federal government for taxes. They have not been making quarterly estimated payments. Are they talking about a couple $100 penalty, $1,000 penalty? Like, can you give us some sort of range of what we're looking at here?
Yeah, I typically see is about, I've seen some as low as about $60 to maybe about, two, three, $400. It just really depends on the amount that's due. But just from what I can guesstimate, if you owe about $10,000 and you have a underpayment penalty is what it's called, I would say you're looking at about maybe $800 or so in a penalty, $600 to $800. So
Okay.
I don't want to say that's not a lot because anything that you owe is money out your pocket, but it's not significant, whereas like 25% of the balance due.
Got you. So there is a penalty for not paying them, but the business owner just needs to wage, is it worth it? So are you required as a business to pay the quarterly estimated taxes by the IRS?
So the IRS law says that business owners are required to make estimated tax payments, but there is no one that I've seen enforcing it where, hey, if I don't get your quarterly payment this quarter, I'm getting a nasty gram letter and you owe us some money or you're getting fined. So
Got you. So you are required, but no one's going to come send you a hate mail or knock down your door and say, "Where's my money?" from the IRS.
correct.
So let's talk about best practices. What should business owners do that are proactively looking at their books, proactively working with a strategist? What should those quarterly conversations look like?
Yeah, definitely. When I work with clients, or if clients do not have tax strategy and they're like, hey, I know I need to do something, what does that look like? I always revert back to the profit first model where I'm like, hey, 15%. Just send them 15% of what your net profit is for that particular quarter, just so you have something to on the books. And then, like I said, if you're sending that amount in, then once you do your taxes for the year, you should be in good shape because you are factoring in, hey, let me just use the 15% number, get them some money for the federal, the state. Well, for the state, I would definitely look at like your state tax rate and factor that in because we wouldn't want to send the state 15%. That would be
That's too much.
overkill.
Yeah.
And all states are different. They're not all equal. So that's typically my rule of thumb for individuals who do not have a strategist. But if you're working with a strategist, especially within our firm, we're able to like pinpoint it down to the T with the tools and the software that we have available to us, where we could say, hey, this is the exact amount. We'll plus or minus it up just a little for a buffer, but we can spot on tell you like this is what you should send.
Got you. Got you. Okay. So definitely, and we've done a podcast about Profit First. We're all Profit First certified. We love it. So if you're doing your Profit First allocations and you have your 15% sitting in your tax account, if you choose to, because the IRS requires it, you can use the money that's in the tax account to make the quarterly payments. So what if, as a business owner, they choose not to make the quarterly estimated tax payments because they're going to be using those funds for tax strategy? They acknowledge the fact that at the end of the day, there is a penalty. What do they need to factor in?
Yeah, so if you're not going to make the payments, and let's just say, your strategist, I tell you, hey, you have a tax bill due, you need to send some money. If you don't, then hey, let's just continue to review what we're looking at quarter after quarter. But definitely, you may want to play catch up for the January 15th payment that's due the next year. Or just be prepared to, hey, when you file your taxes, expect that you're going to pay what you owe and the penalty, and we can calculate that for you as well
Yeah.
if you need to know.
So, how, as a fractional CFO for businesses, typically when I'm having conversations with our clients, my conversation is you are a profitable business. You are going to have a tax liability unless our tax strategy completely wipes it out. So we do need to be setting some money aside for tax purposes. And many of my clients want to exit soon. So we do need to have a profitable business, a profitable tax return. But typically, a lot of my clients can do a lot with their money and get a higher return than sending it to quarterly estimated tax payments. So some of my clients have elected not to make quarterly estimated tax payments because with that $5,000, They can put it into Facebook ads, get more clients, turn more sales, do their allocations, and get a higher ROI on that money than sending it to the IRS on a quarterly basis. And they just acknowledge the fact that I'd rather use that $5,000 on a quarterly basis and pay $1,000 fine at the end of the day, because the $1,000 fine is less than the return I'm going to get on using my money. Now that's my CFO hat. Poke holes in it, Alexis.
Hey, I think it's logical. As long as the client knows, like, hey, when we get to tax time, if you don't do it, this is the repercussions of it, and it's not a surprise. So I'm all for the CFO strategy. I can put that hat on as well, and it makes logical sense to me, as long as the client knows and it's not a surprise.
Yeah.
And like you said, there are strategies that can wipe away tax bills. So if you're turning that on, it just really depends on what strategies we're turning on for a client, because you can potentially say, hey, I know I'm going to do an advanced strategy. I'm going to wipe my whole tax bill away. There's no need for me to even talk about estimated tax payments. So it just really depends on the game you're playing and what your setup is with your tax strategies and your tax plan. And then we just operate in that box and make it work for you.
Yeah, I love that. And that's the point here, guys, is the IRS tells you what to do. And as a business owner, you need to understand the context in which you're getting that information. So if your tax preparer is just saying that 2025 is going to look exactly like 24, pay the $10,000, and you know that you're killing it right now, that's not a good strategy. Or your business is suffering. You don't need to sending that money out to the IRS could be a detriment to you, because you need that money for inventory or for payroll right now. So the key distinction here is to have accurate reporting of numbers and have a conversation with a tax strategist to figure out, what does it look like I'm going to owe this year based on this year's numbers, not on last year's numbers, and have a conversation about what are my options, and be able to say, okay, yes, I'm going to go ahead and make a payment this quarter, but not next quarter because of XYZ.
Right. That makes perfect sense.
All right. So talk to us about some basic calculations with this.
Yeah, so definitely there are some basic calculations that we consider. We consider like the 100% safe harbor or 90%. So what that does is it looks at, again, last year's tax liability, and it's saying, hey, we're either going to do 90% for this year or 100% of the amount. So there are some factors where, hey, if you did the 100%, then you can avoid a penalty if one was, implemented. But again, it just really depends on where we are with that. But like I said, if you have like a huge increase in, tax strategy, the IRS is just not going to penalty. So again, it's up to you as the business owner per se to know your numbers, understand like what your net profit is from one year to the next, so that if you're not working with the professionals who are managing this stuff for you on a quarterly basis, that the red flag could come in your head to say, hey, I need to talk to somebody and see what the implications are with this, because of the math that I did, or I followed these coupons that, my tax return gave me, to
Right.
just understand like which direction you're heading in, so you don't have any surprises when it comes to filing the taxes.
Okay. So, Alexis, what if a business owner just has a tax professional? They see the little vouchers and they send in their checks, and their business does considerably better in 25 than it did in 24, but they paid the vouchers. So they paid their 10,000. Are they still going to have a fine if they owe 20,000 in taxes, but the voucher said to pay 10? Are they going to get a fine on that?
Yeah, so if you follow the 100%, what the IRS does is it allows you to avoid the penalties
Okay.
from the IRS. So if you did overpay or underpaid, but you did it based off of the vouchers, then the safe harbor allows you to avoid the penalties.
Okay, got you.
So we just need to factor that in when we're making those payments so that we know this is the game plan that we're headed towards.
And it comes down to each individual person's threshold for risk and tolerance of what they're willing to push on this. Because I have some clients that pay the vouchers, on time without fail. And then I have other clients that are like, nah, I can do more with my money than the IRS. And I'll chalk up and pay the $1,000 fee when it comes to it. And then everything in between. So it really comes down to what your tolerance is for pushing this. But by the book, what you're saying is the IRS says, yes, pay the vouchers, pay them on time. And if you pay them 100%, if you underpay or overpay, there's no fees. But be prepared that if your business has changed at all, you need to have a proactive conversation with someone that's on your side and understands your goals. Because the answer isn't always don't pay taxes. Sometimes the answer is if you're trying to exit or get an investment or a bank loan, you do need to show strong financials. And so this might be the year that you're going to pay taxes. So throw in a little extra into those quarterly payments.
Right. Yeah. And that's good. And one more thing to add to that safe harbor rule is the adjusted gross income, because that plays a factor as well. So we need to understand what that amount is for you or your spouse or whomever you're filing your tax return with, to just make sure that it's in alignment with avoiding the penalties as well. So there's a lot of calculation going on behind the scene that we need to look into before we just say, hey, you're totally clear because you fall under safe harbor.
Got you. Perfect. So with this one, business owners, it's a like every tax question, it depends. So the IRS says pay it, right? But should you in your current business situation pay it? It depends. And that's where having a tax strategist, Alexis and her team can really come in and help you and say, with your current situation, yes, pay them. Don't pay them, pay more than. Because it's not a one size fits all answer when it comes to quarterly estimating taxes. What other pieces of this puzzle do we need to understand, Alexis?
I'm glad you asked. I love this topic. One of the things that I always say, especially when working with new clients, is that you have to understand the different taxes. I always get, hey, I pay estimated taxes. I don't have to have payroll taxes withheld, or I don't have to do sales and use taxes, or I don't have to do these taxes. I already paid them. Or people will think, hey, I had W-2 taxes withheld from my paycheck. Like, I don't have to make estimated tax payments, and they don't consider it. So just really understanding that if you are an S Corp or C Corp, or you're on W-2 payroll for your company and you're having withholding taxes, FICA, Social Security, or federal and state withholding taxes taken out, that is separate taxes. We need to be concerned with the net profit of your business. Like, what is that profit and loss report going to say? And that's where we're considering estimated taxes, because you're either going to pay the flat corporate 21% tax rate if you have a net profit, or if you're a pass through and it's flowing over to your 1040 from your S Corp, you're going to have a tax bill due if there's a net profit. Or if you're a Schedule C sole proprietor, you're going to have self-employment tax as an estimated tax. So we just need to understand what you're dealing with, but understand that there are different levels of taxes and different calculations. And you just need to understand that estimated taxes are for your business net profit. And just really be clear on that. I can't tell you how many times I work with a new client and they're so confused, and I'm like, wait a minute, you don't understand.
That's it.
Yeah,
There's lots of different taxes here, friends, and you need to understand which one's in front of you right now and
right.
how it pertains to you and your business, where you are.
Definitely.
Because you're right, payroll taxes help for your personal taxes, but don't exempt you from quarterly estimated taxes, and people get super confused.
Definitely. So, definitely knowing the taxes, but just making sure that, of course, if you are paying them, this is another thing I see. If you're making the payment to the IRS, is always good to do that. You can do direct pay. However, making sure that they're applied to the right account. I can't tell you how many times that clients will do this on their own and the taxes, they're like, I made the tax payment, and the IRS is like, no, we don't see it. And it's applied to a past due balance from prior years or so. And it's like, oh my gosh, now we have to move money, or you don't get to move the money, and then you just messed up your whole tax situation.
Yes. So if you choose to pay and use the vouchers, make sure you pay according to the instructions and you send it to the right accounts and you check all the right boxes, because then your tax team is going to have to be chasing the IRS and saying, she didn't mean to send it to this one. She was trying to pay this one. And the business owner, you're like, but I sent him $15,000. Where did it go? Like, it's a nightmare.
Right. Completely a nightmare.
And hours of Alexis's team's time arguing with the IRS about where the money should have gone.
Right, that part. Yes.
Okay, perfect. Anything else, Alexis, that we as business owners should know when it comes to the topic of quarterly tax payments?
Well, definitely. Again, just understand your numbers. I can't tell you how important that is. Um, follow, I'm a big proponent of profit first, just making sure that you are setting aside money for taxes and understanding like, hey, based off your business net profits for the quarter, that you potentially may have a tax situation that requires you to make estimated payments. One of the biggest things as well is don't get caught up. Like you really should understand this because I can't tell you how many times where clients are just like, oh my gosh, I didn't expect this. I didn't know this was going to happen. Where am I getting the money from? I can't afford this. And they carry bill after bill after bill after bill, year after year. And it's like, oh my gosh, now I owe the IRS all this money, all these penalties, all this interest. So again, if you're a business owner and you're like just really on the small side, I see this happening a lot with the smaller business owners who may, do some 1099 contract work or they have a regular W-2 job as well in addition to their business. And they just lack the knowledge of not understanding, hey, for one, you need books to track the expenses. That's a whole nother topic.
Yes.
Where you got to track the expenses for the business to offset the income. So you're not just saying, hey, I got a 1099 for $10,000 and you clearly have no expenses to offset that so that you can see what your true net profit is. So you definitely just want to consider that, track your expenses if you don't have a bookkeeper or bookkeeping team handling your financials for you, because you don't want to leave anything on the table. I don't want to overpay more in taxes if I don't have to. So just really understanding like what can you write off, so that you can determine like what that true net profit is, so you can determine what do I truly need to pay in estimated taxes.
Yes, 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 yes. I love it. All right, Alexis, this has been a great topic. I've learned a lot. Business owners, you've got to know where your numbers are, and it is imperative that you have conversations with tax strategists. A tax professional is going to meet with you once a year and say, congratulations, this is what you owe the IRS. Tax strategist, which is what Alexis and her team are, we meet quarterly with our clients. We look at the budget that the CFO has made. We look at the books that the bookkeeping team has done and let you know this is what it's looking like. This year is much different than last year. Just going along with the vouchers isn't going to work. Here's what we recommend. So make sure that you, as you are up leveling your business, you are up leveling your financial team and your financial strategy, because just paying those vouchers isn't the answer for everyone. Make sure you have someone on your team that's guiding you and understands what your goals are and how your business is doing, both the rear view and forward view of your business. All right. Anything else, Alexis?
No, I think we covered everything today. That's key. Like I said, sounds like we can have a whole conversation on some other things surrounding estimated taxes, but we covered the basics today.
I love it. Look, business owner, if this is confusing to you and you're like, hold on, I didn't know I was supposed to be doing this. I need help. Just go to pamjordan.com and book a call with our team. We would love to do an analysis of what you've got going on, have a strategy call, and figure out the best way to help you moving forward. Also, don't forget to subscribe and like on Apple Podcasts, YouTube, Spotify, or wherever you listen. Remember, it's not what you make that matters, it's what you keep. We'll see you next time on the Pivot to Profit podcast.